Well, thank you very much, Raleigh, and thanks to everyone at Trading Pub for hosting this event, and most importantly, thanks for everyone that has chosen to join us today. So I'm going to do things a little bit differently today. We're going to talk about the exit side of the coin when it comes to trading. So in terms of what to expect, again, when we deal with exit strategy, I know that most traders, especially newer traders, like to focus on trade entry. In fact, that's what most traders focus in on most of the time anyway. But I am going to take it from a different approach today. Certainly, trade entry is important, but to be honest with you, trade exit is where the real money is made, and we're going to talk about that. We're going to talk about why traders in general tend to screw up this idea. In other words, why do they tend to get out of winners too soon? And why do they tend to let losers go too long? How we can avoid this idea and actually turn it on its head. And then I'm going to actually show you 4 strategies that you can use, and you can tailor them to your personal trading personality. So hopefully you'll find it educational. Raleigh explained this a little bit, but that's me on the left there. I've been trading for, I guess it's almost 15 years now. The first 6 or 7 were pretty horrible. Blew out several accounts. Just kept trying to chase the holy grail, if you will, trying to find the perfect setup. And it wasn't until I serendipitously met my partner Dave. He showed me a new way of looking at how the market really works, understanding what my role is as a trader, and it's not to just chase trade setups all over the place. And so that really turned things around. And like Raleigh mentioned, we've since combined forces and provided and we've developed we basically set out to create a tool that he and I wanted to use. We found that it was very helpful, and we've allowed others to use that now as well. So again, there's more about us on our website, which you can certainly check out. But today we again want to focus in on trade exit management, trade management strategy. And again, that's important because it's where the money is made. It's what really separates good traders from bad traders, great traders from good traders. Exit management really is so much more important than most people give it credit for. And our goal in exit management, you've probably heard the old axiom, cut your losers short and let your winners run. Obviously, it makes good sense. You want to maximize your gain on profitable trades, and you want to minimize your loss on losing trades. You're going to have losing trades. If you can learn to minimize the loss on those and maximize your gain on profitable trades, it makes a huge difference to your P&L, obviously. The problem is it's very difficult to do. It goes against, as it turns out, kind of our human, okay? And as you know, if you've traded at all, when there is actual money on the line, when you get out of sim and you're trading actual money, there's pressure. Doesn't matter if you're trading one contract or 25 or 50. When you have money on the line, there tends to be pressure. And when there is pressure in any part of our human life, we tend to revert to what are called heuristics. In other words, another way of saying that is our unconscious decision-making shortcuts that we've been wired to kind of think. It comes from the fight or flight idea from way back. So how this applies to trading is that we naturally tend to want to lock in gains quickly, and we want to avoid taking losses at all. And there's a lot of research on this topic. One that my partner showed, kind of the nugget with this one. It's by Daniel Kahneman, is a Nobel-winning economist and behavioral scientist. One of his sayings is that people are risk-seeking in the domain of losses. What that means is that except a certain loss, people tend to be more risky. So let's say that you're down a point and a half, 2 points on a trade, whatever the case may be. Oftentimes, that's more painful, just taking that small loss. That's very painful to do. We're actually liable to be more risky and say, I'll let this thing go a little. I'll widen my stop just a little bit more. Let's just see if this thing turns around, because taking that loss is painful, and we tend to be more risk tolerant when we're already down. On the other side of the coin, Kahneman says people are generally risk averse in the domain of gains. And how that applies to trading is that when you have a profitable trade going, we tend to get tight. We want to lock in that trade. We feel very risk averse. We don't want to see that go back to zero or go back to a loss. So we're more likely to be risk averse when we have a profitable trade and lock in a winner. But what happens is if you don't learn to maximize your gain on your winners, and you tend to take larger losses than you should on your losers, it skews your P&L to a very bad direction, obviously. And so the obvious question then is, how do we overcome these innate tendencies? If this is how we're wired, how do we overcome them? So we believe there are several steps. The first is simply awareness. If you're not aware that our brains are wired like this, you can't really overcome it. So one of the ways that we really recommend doing it is to really start actively monitoring your emotions while you're trading. If you're very serious, and this is something I've done for a week, it's very difficult. I highly recommend that you do it. I know most people won't because it's difficult, but if you are very serious, one of the best exercises you can do, just to take a little side note here, is to basically set your phone or your watch for every 10 minutes to ding. And what you're going to do is you're going to journal your emotions, whatever you're feeling, whether you're in a trade, whether you're waiting for a trade, whatever your emotions are, you want to journal those emotions every 10 minutes for a whole week. And again, this is going to be a not very fun week. It's a tedious exercise, but what it's going to do is really train you to start focusing first and foremost on your emotions. Okay. I have actually learned over time that as much as I love our software and our indicators, my number one indicator is my emotional state. I know that when I am in a calm, relaxed, detached state, and I'm just looking at the market and focusing on managing my risk and making good decisions, I tend to do very well. When I tend to get focused on the money, when I tend to start chasing money or worry about losses, whatever the case may be, I'm not in a good emotional state, I tend to do poorly. So simply by doing that journaling exercise, you start to train yourself to look first and foremost at your emotional state, and you'll be amazed how that correlates to your results. I truly believe it. I've seen it with myself. I've seen it with people that have done it. So it's a very good exercise. I know I'm getting off topic a bit, but I think it's a very important lesson. So in terms of exit strategy, you certainly wanted to, at a minimum, start understanding how you tend to feel when you're in a trade. What is your tendency? In other words, do you tend to want to exit winners early? Do you tend to take bigger losses to avoid the pain? Do you tend to take really small losses because as soon as you're down, you feel like I got to get out, I can't take any loss? You just want to be aware of what your tendencies tend to be so that you can overcome that. Then the next step to overcoming these tendencies is to have and there's really no way around it. You have to have some mental toughness to succeed in trading. You have to be committed, and you have to make a decision to want to overcome this natural wiring. And again, it makes a huge difference in your P&L. And I think the missing link with this is, we've talked about being aware, we've talked about being mentally tough. Those are extremely important. Another factor that's extremely important, in my opinion, that makes it much easier to do those things is to actually have confidence in what you're doing. If you have a confident market, if you have confidence in how you're seeing the market, if you have confidence in the way that you attack the market and manage your risk, you are going to automatically or amazingly, if you will, have more discipline. I used to think I was very undisciplined when it came to trading because I would take a trade that I thought was good, it would stop me out, I would start to question myself, I'd go back to the drawing board, and it was just a mess because I thought, oh, I just don't have discipline, I have to work on that. That really wasn't the case. It was that I didn't really know what I was doing. When I figured that out, I automatically or amazingly found that I had more discipline. When I understood that, hey, that was a great trade, I would take that trade 100 out of 100 times. The fact that it lost on this given trade, that's no fun, but that was a great trade. I'm not going to let it bother me. Okay, next. So it's that idea of when you have a better understanding, you can have more confidence. That translates to more discipline automatically. So, and again, with better confidence, you also make better trading decisions. And that's how we look at ourselves as traders, or what we try to teach. As a trader, you are a professional decision maker. There's really only three things you can do. You can buy right now, you can sell right now, or you can do nothing right now. That's the decision. That's the scope of your decision making's possibilities. But the better that you get at making decisions, and the better you understand the market, you'll be able to make better decisions. The better decisions you learn to make, the better your results are going to be. If you actually focus on your results, you'll have poor results. But if you focus on being a good decision maker, the results tend to take care of themselves. So in the next part of this presentation, we want to talk about how to gain that better confidence, that better understanding. And the key is to first understand how the market really works. In other words, why does price really move up or down? Then you want to be able to see it in real time. And then you want to be able to apply that in real time to both your trade entry and, especially in terms of the scope of this presentation, your trade exit. And we'll talk about several different strategies for trade exit, and I'll show you several examples, recent examples, and that sort of a thing. So first step, we want to understand. We want to understand how the market works, why the market moves up or down. And very simply, the market only moves when one side, by one side I mean buyers or sellers, is collectively more aggressive than the other side. We call this either buying aggression or selling aggression. And you may have heard, talking heads on the news or something like that say, well, the market went up today because there were more buyers, or it went down because there was more sellers. Now we know definitionally that's not accurate. There has to be an equal number of buyers to sellers. For every contract bought, there's a contract sold by definition. So it's not about more buyers or more sellers. It's about more aggression collectively by buyers or sellers. In other words, the market is going to collectively buyers are more aggressive, and it simply must move down if sellers are more aggressive. Okay. I like to use to explain this. I like to use one of many different analogies, but basically real world analogies. I like to use those a lot when we talk about this stuff and when we teach. But let's use an example of something that we've all done. We've all bought a car or bought a bicycle or whatever the case may be. And let's say that you're looking for a used car and you go on Craigslist or whatever, and you find Bob who's asking $20,000 for his car. And you want this car, but unfortunately your budget is $19,000 in this example, okay? And again, I know in real life you'd probably meet in the middle at 19.5 and call it a deal and move on. But for the sake of this example, either has to sell it for 19 or for 20. Has to sell on an even thousand. So what would happen if neither you, who's willing to pay 19,000 for the car, or Bob, who wants $20,000 for the car, what would happen if neither one of you was willing to budge on price? Well, very clearly, there would be no deal. In other words, the quote market for this car, the price doesn't move. Okay, you're still willing to pay 19. Bob's willing to take 20, but neither one of you is willing to budge, so there's no transaction. This market, so to speak, stands still. Now, on the other hand, what if you as the buyer really want this car? What if it's the car you've been looking for and you really want it? You're afraid someone else is going to come snatch it. Well, what do? In this case, you as the buyer have to become more aggressive. You have to be willing to pay up to what Bob is asking, okay? So all of a sudden, when the buyer in this case is more aggressive, when they're willing to be more aggressive, a transaction occurs, and the quote price in this market for this one car has gone up because the buyer was more aggressive. Now, conversely, what if Bob is worried that he's not going to find a better buyer than you? He's got to sell this car. In that case, he, as the seller, has to become more aggressive. He has to be willing to take your $19,000 offer. So in other words, again, Bob, as the seller, has to be more aggressive, and the market, quote market in this case for this one car, a transaction occurs and the price goes down in this market, okay? So that makes sense when you're talking about one car, hopefully, but the same principle applies to any market that you're trading, any electronic market that you're trading. This process, depending on the market, tends to be happening hundreds or more times per second in all of these markets, but the same logic applies. While we were just talking about one car, in this case, we're talking about hundreds and thousands of individual traders, institutional traders that collectively make up the market. And if in any given moment buyers are more aggressive than the sellers, the price is going to go up. And if at any given moment are more aggressive than the buyers, the price is going to go down. It's really that simple. There's no other way. That's the price discovery mechanism of the market. That's how it works. Okay, so if we understand how it works, then the next step logically would be, okay, great, we understand how it works. How do we then see it, and how can we see it in real time, ideally? Okay, what you would need to be able to identify this are a few things. Number one, as we know, we have to be able to determine which side, again, buyers is more aggressive at any given moment. So that's the first thing that we have to be able to understand. Now then, ideally, we would also like to be able to understand to what degree that buying or selling aggression is coming in. So if you can determine the relative strength, is it moderate buying, is it strong buying, is it extreme buying aggression, you have a much better feel than just knowing if it's more buying or more selling aggression, okay? And then ideally, if you can see that quickly, clearly, and in real time, be able to look at a screen from across the room and be able to tell which side's in control, then you're going to be able to make better trade decisions. You're going to have more confidence. That's going to lead to better results. Now, the tool that we have developed to help you do with these three things is what we call relative aggression bars. So I want to explain that because I think it's important to kind of give you the foundation and then show you how you can apply this to making better trade exit decisions, which again is the point of this presentation. So again, this is an example of our relative aggression bars. We have 3 levels. We have this level 1, or what would be called moderate buying or selling aggression. We have level 2 or strong. We want to pay attention to those especially, and then even more so these extreme or level 3 selling aggression bars. Again, which side's in control and the degree to which side they're in control, and they act as a bit of a roadmap to the short-term direction of the market, whatever time frame that you are trading. Okay, so the way that this is different, here comes another silly analogy, but these are different than most indicators. Most indicators are lagging technical indicators. They're telling you what happened over the last 20 bars or the last 50 bars. And that certainly is good information, don't get me wrong, but I would rather personally see what's happening right now. Okay, I want to see which side is more aggressive, because it's aggression that leads price. And it's not just price action. Price action also is important, but I want to see what causes price action, okay? So this is if you imagine a duck on a pond, for example. You can look at a duck on a pond and see if it's moving forward or moving left or going fast or going slow. That's in essence the upper half is price action, okay? And if you want to put a technical indicator, you can see what the duck has done over the last 20 minutes or whatever the case may be. What we're looking to do is we're trying to get under the surface of the market and look what it's, what are those flappers or whatever those are called. Sorry, I don't know the name. The duck paddle things, whatever those are called. We want to see those. We want to, because that's what causes the duck to move fast or slow, right or left, up or down. That's what causes it. That's what leads to the quote price action. That's what leads to what the duck does. Okay. Yeah, feet. Thanks, Mark. I guess that's a good way to say it. Sorry. Yeah, so I'm not a duck scientist, I guess. Yeah, webbing, maybe that's it, Bill. Thank you. I appreciate the help. But hopefully, anyway, you get the concept. So we've step 1 was understanding, and I know I'm going through this quickly. There's a lot more in depth we can get with this, but step 1 was understanding why price moves. Step 2 is understanding how we can see it, which is with the relative aggression bars. And then step 3 would be how you can apply these relative aggression bars to your trading. So mostly about this is the make better trade exit decisions, okay? But I want to also show you a few other things, and which include being able to determine more clearly which side is in control of the market at any given time, being able to identify when there is a true breakout or a true trend day as opposed to a head fake. I think a lot of, especially newer traders, get caught into that trap of jumping on a move higher only to see it turn right around. I want to talk about how you can better identify when they are legitimate. Another way of identifying in real time when there is likely a choppy or consolidation day, or what we call a horizontal day. And then also how you can identify more high edge trade entry location a little bit better. So I want to briefly touch on that, but then we're going to start really focusing on the exit decisions, and I'm going to give you a few different techniques that you can use, okay? So the first way, in terms of applying these, is to determine which side, again, buyers or sellers, is in control of the market. This is I did these slides Tuesday night, so I've got a few slides from either Monday or Tuesday. Nothing special and no cherry picking. It's just picked them out from that day or 2 days before. So this is an example from Crude on Tuesday, and there's a lot more that goes into the software, but for simplicity's sake, I eliminated everything except for these level 2 and level 3 aggression bars. Okay, so the green are level 2 or strong buying aggression, the level 3 or extreme buying aggression, and then you've got a red, which is a level 2 or strong selling aggression, and a magenta, which is a level 3 or extreme selling aggression. And basically the idea here is we've got the breakout here on the high, we've got extreme buying aggression. There's not any selling at all until about this time around 11 o'clock Eastern time. So what's that telling us? It's telling us, number 1, and we kind of call this rule 1, it's telling us that, I guess what I would say is rule 1 is avoid making stupid trades, okay? Avoid being on the wrong side of the market as much as possibly you can. If you did nothing else but avoided a few bad trades that you would have otherwise taken, your P&L, there's going to be a huge difference in your P&L, okay? So in this case, we've got clear buying control of this market. If you got any kind of a short signal with whatever method you're using, you would absolutely know you need to avoid that, okay? Now, once the selling comes in, now it's okay, more of a two-sided market. And then the buyers come back in, sellers come in over here. Again, it's just telling you which side to avoid, number 1, and then number 2, which side makes more sense to be on, okay? So in other words, which side is in control gives you a much greater edge on making trade entry decisions because you can avoid we call it avoid stupid trades, avoid low edge, low expectancy type trades. So that's one way. Another way, and this looks like a similar chart, obviously, but this is from Monday. This is in the ES, the mini S&P. If you remember, we had the huge move right off of the open here. This is the first half of the day. Again, I've removed everything except for the level 2 and level 3 bars. But this is a case, when we're making a new high or making a new low, does it occur on a nothing bar, on a gray bar, or does it occur on one of these extreme level 3 buying aggression bars? Or if it was, excuse me, does it occur on a level 3 selling aggression bar? It doesn't always mean you're going to have a huge breakout. There are times where it'll turn around on you, but the vast majority of the time, it's going to identify that you have a much greater chance of having a nice breakout or a true trend day. In fact, I don't like to use always and nevers. I don't do that, but it's nearly always. If you look back on a big trend day, it is almost always that it was begun by a level 3 buying or selling aggression bar. So, if you're looking to be a buyer of breakouts or sell breakdowns, if you can limit that to when you see that happening on a level 3 buying or selling aggression bar, your odds of that breakout really doing something vastly improve. So that helps you identify true breakouts, true trend days. And again, in this case, you would know every time we've had a buying aggression bar, we've had follow through. Every time we've had a little bit of selling come in, it just gets rejected right away and the buyers take it right back out. So again, it's telling you, which side do you want to not be on? Well, you don't want to take any short entries that you might get in this situation. And you certainly would want to be more confident or more comfortable taking any long entries, okay? So hopefully that makes sense. Another way, this is obviously important, you want to be able to identify choppy days or horizontal days more easily. And we have several other tools that do this, but just in terms of what these relative aggression bars can help you do, in this case, what you're looking for, this is an example from Tuesday from gold. Again, I made these slides Tuesday night. In this case, you see that all we have are level 2 bars. There are no level 3 bars at all. These level 2 bars don't really have any. There's just not much conviction. There's no major aggression. There's no extreme aggression at all. Nothing's really happening. There's no conviction. So more than likely, this is going to be a choppy day. So if you are a momentum or trend-based trader, you know that you need to be very careful on a day like today. If you are more of a fade or reversal type of a trader, you know this is what you're striving for. You know that being a buyer on a consolidation low or a seller on a consolidation high makes more sense on a day like today. But again, you're helping improve your edge to be able to make sense of what the market is really doing, what context we're in. So we've talked about a few, identifying likely breakouts, likely choppy days, helping you stay on the right side of the market more often. Another way that you can use this, obviously, and a lot of people do it this way, is you can use these relative aggression bars to identify high edge trade entry locations. So again, I could go for an hour or two just talking about trade entry locations. We're not going to do that. We're going to focus mainly on the exit side of things, but I wanted to just touch on how you can do that because I think it's important. Now, let's say the first way that you can use this is what we call a decision aid. This is a way a lot of our users do use this tool, and you'd be amazed at how many people say, well, this was kind of the missing piece to the puzzle. This took me from a slight loser to a winner. It took me from break even to a winner. This was the piece of the puzzle that really helped solve it. And the idea here is that let's say you already have a trading method or a trading system or whatever the case may be. What you'll do, let's say you got a long signal, okay? If you get a long signal using the methodology you're already using, simply refer over to our software and use it as a decision aid. Is the software showing that buyers are really in control? Great. You have more confirmation, more confidence in that trade. Or in the other, in the other case, are you seeing that sellers are actually coming into the market? Are you seeing that there's been a rejection? Are you seeing that we're up against a resistance level? Okay, that would be more of a, a red flag, a think twice. Well, and maybe I want to skip this trade. Maybe I want to lower my position size, okay? It's a decision aid for what you're already doing. Very powerful using it in that way. Obviously, another way that you can do it is as a standalone. In our member center, we have various, I think there's 12 or 13 different trade entry ideas in there, or trade entry setups that we can use. You can use these as a standalone. We have what we call confluence trades. We have what we call go with trades, which are momentum and trend-based trades, reversal. And as a little bit of a side note, this was probably the biggest turning point in my career in trading is when I learned that it's not just about taking trade setups. So many of us as traders, we say, well, if A and then B and then C happen, I take my trade. And you think of trading like science. And I suppose that works for some people. I don't know too many people that actually it does. But I know when I tried to do that, I tried to come up with trade setups, and I just would focus on this rule and this rule and this filter and that filter. Didn't work for me. When I learned to first understand the context of the market. In other words, are bulls in control? Are bears in control? Are we in a vertical mode? Are we in a horizontal mode? What's the context of the market call for? What's the level of opportunity out there? Okay, which side do I not want to be on? Which side do I want to be on? When you understand that context, then you can apply just about any trade setup that you might use, and you're going to have a much greater edge. So if the market's in a vertical up mode, you don't want to be shorting the market. You want to be applying any of your trend-based or momentum-based or pullback retracement type long trade setups. Okay, hopefully that makes sense. It's such a crucial important point. It really was truly the turning point for me when I learned that it's not about trade entry setup. It's about context first, then honing in on trade entry setup that applies to the context of the market at the given time. Okay, so hopefully that makes good sense. Doriel, I will. I'm going to save some time for some questions at the end. I appreciate the question. I will get to that at the end. So again, use it as a confirmation aid. Use it as a standalone, or obviously you can combine it and use it for multi-purpose. A lot of people do this as well. They'll have some of their own setups that they use. They'll then apply some of the setups that we teach. Kind of use that as a combination within their trading plan. So that works very well as well. That's what a lot of people do. So again, we've talked about, just as a little bit of a review, we've talked about determining which side's in control, identifying when there's likely a breakout or trend, identifying when it's choppy, talked about ways you can use this for identifying edge trade opportunities or trade entry location. We've briefly touched on those. And again, I could talk for an hour on each of those topics, but what we want to really kind of hone in on today is making better trade exit decisions. So that'll be the next part of this presentation. So just as a side note, when Dave and I designed this software, we didn't really think of it in terms of the exit side of the coin. I don't know why we didn't, but it wasn't really our thought process. We were thinking about making better sense of the market, and we were thinking about really honing in on trade entries. So it's been a little bit of an unintended consequence that it turned out, wow, this is really amazing for helping us manage our trades. And there are several of our users, I would say quite a few actually, who have a trade entry method that they like, and they simply use our software as a supplement, and they use it just for managing trades. That's a great way to use it. There's no right, there's no wrong. It's really about using a tool to help you see the market better so that you can make better decisions. And as we know, better decisions lead to better results. So again, that's how some people use it, just for managing their trades. And the goal of exit strategy, very simply, we touched on this before, is to maximize our gain on winning trades, minimize our loss on losing trades. You will take losing trades, minimize them as best you can. You will have winning trades. You could just flip a coin, you're going to have both, but you will have winning trades. If you can maximize your gain on those winning trades, really helps. In other words, just like the old trading axiom that we've all heard, you want to be able to cut your losers short and let your winners run. And the reason that this is so important, I know we touched on this a bit as well, is that we talk a lot about incremental improvement, marginal improvement. There is no holy grail. This is not the holy grail. There is no magic formula out there. And I know a lot of early stage traders, and I don't know what our makeup is in this webinar today, if it's a lot of early stage traders or a mixture of more experienced traders. But if you are an early stage trader, I beg of you not to go down the road that almost everyone goes down. And maybe it's inevitable. I know I went down it. Maybe it is inevitable. I don't know. But I know that you want to believe there is some magic trade setup out there that's going to solve your problems, that's going to just help you win, 93% of your trades. And there's a lot of people that'll tell you that exists. And maybe it does. Who am I to say? I don't know everything. I'm not aware of it. Let me put it that way. But what we know does work is understanding the market, being able to put the market in context, and then being able to, over time, make marginal and consistent improvements, because those, what seem like small improvements, add up to major differences in your P&L. So imagine, this is very, very reasonable. I'm not even going to say 50%, but let's just say you only had a 10% increase, in your average winning trade amount, and you only took a 10% decrease in your average losing trade amount. Okay, it doesn't sound like much, but if you look at that over the course of a month or a year, it makes a huge difference. And that's just 10%. So it just shows you the power of marginal improvements. And that's what another thing that really successful traders do is they're always looking for a way to increase their edge. They're always open to new ideas that are good. They might have a really good philosophy, but if you can add an extra 10, 20, 30% to your winning trades, it makes a huge difference. Okay, so that's what we talk about. So in this case, let's first talk about some of the common trade exit mistakes. And these tend to all be fear and emotion based. But on profitable trades, generally speaking, and this goes back to our heuristics that we talked about earlier, most traders tend to exit winning trades too quickly, losing whatever profit they've earned so far. On losing trades, most traders do one of two things, generally speaking. They tend to exit losing trades too quickly. In other words, they get down a couple ticks. I got to get out. I can't take any loss. It's just painful, right? That's one way. Or the other side of it is that they tend to let their losers kind of hang on too long. Well, I'll move my stop down. I'll move my stop up. Let's just see if this thing turns around, because taking a loss at all is so painful. Okay, so those are some common mistakes. I want to, I guess, introduce you or encourage you to think of it a little bit differently. So instead of thinking about from the fear-based strategy or a fear-based idea, think about it like this. You got into the trade for a reason. Hopefully you didn't just flip a coin. You got into the trade for a reason. You were able to identify that bulls or bears were in control. You were able to identify a good trade setup, whatever the case may be. There was a reason you got into the trade. Therefore, it stands to reason that there's no reason to get out of the trade until that reason is no longer valid. Okay? So in other words, you want to exit when the evidence tells you to do so. You don't want to exit sooner than you should based on fear. You also don't want to be greedy and exit later than you should based on fear of missing out on a huge trade. Okay? You want to exit at the right time. And the only way you can do that is if you have good evidence to work against. So again, you got into the trade for a reason. Get out when the evidence tells you it makes sense to do so, not before, not after. Okay? So for example, let's just say that you got long here, and I don't know if you can see my cursor. I think you can. Let's just say you got long here in hypothetical. You want to, and these slides are actually from our member center, so obviously you can see the price here on the ES is not where we are right now, but the logic applies. It's not relevant that it happened yesterday. The same logic would apply. So again, let's say that you're long from here. Profit and the market starts going sideways. Oh, that's half an hour goes by. It's just going sideways, not doing anything. It's easy to start talking to yourself, to have all these thoughts. I better get out. I better get out. But there's no evidence that bears are entering the market. Okay, you don't see any of that until up here when we start getting these red bars, these level 2 selling aggression bars. So in other words, you can hold your trade a lot longer because you got into the trade on good logic, a breakout on a level 3 buying aggression bar. Let's stick with that trade until we're either stopped out, which typically you're going to see evidence before you get stopped out, or until we actually see selling come in or fail or buying fail. Okay, you can see here we see some buying fail, we see some selling come in. Okay, there's actual evidence that makes sense to get out of the market at that point. Okay, now hopefully that makes sense, and that really is pretty simple, and it really can be that simple, and you don't have to take it any further than that. But if you do like this idea, there are some levels that you can take it. There are some ways you can take it to the next level, if you will. Okay. One is that you can match your exit strategy to what we call your trading personality. And then two, we've talked about market context a bit, but match your exit strategy to the market context. So the first way is to match an exit strategy to your trading personality. And this is a big point that we talk about a lot. No two traders are the same, and there is not one black and white perfect way to trade. There are a lot of ways to trade as long as you're doing it based on good evidence and good decision making and good process. That's what we teach. Once you have those fundamentals, then you want to tailor those fundamentals to your trading personality, to your risk tolerance. Okay, some people prefer more certainty. They would rather, to use a baseball analogy, if you're familiar with baseball, they're comfortable hitting singles and doubles and having a very consistent but smaller profit and loss growth. It's more of a patient grinding approach, kind of making sure that account goes up a little bit each day. Okay, nothing wrong with that. It's a great approach. If you are more apt to deal with variance and you're willing to have a few more losses, but you have, but you want the greater profit and loss growth that comes with that, you're looking for more doubles, triples, and home runs, you're willing to occasionally strike out, then you're going to be more on the right side of this. But it's important to understand where you fall on that, because that affects, if you're trying to hold trades forever and that goes against your personality, it's not going to work. If you're trying to scalp out really quickly and you want to really lock in some bigger gains, that's not going to work. It has to match your trading personality. Again, this is not so much a science, it's more of applying science and making it an art. And understanding yourself, understanding your personality is a huge part of that. So we're big into finding your own style, finding your own, using the fundamentals, using the understanding of the market, using the decision-making process that works, but then applying that or tailoring that to your personality, okay? So that's one way. Another way of thinking about it is to match the exit strategy to the market context. And again, this is another huge mistake that traders tend to make. There are no true trades that are exactly alike. So at least in my view, it doesn't make sense to manage all of your trades exactly alike. Again, that's my view. It's what's worked for me and worked for a lot of people. But some people don't. My personal view, and what Dave's view is as well, is you want to adjust your exit strategy to the context of the market. Okay, so it's similar. Another analogy. I know the Masters golf tournament starts today, right? It's like in golf. If let's say you have a 100-yard shot, you don't always hit the exact same shot from 100 yards. You have to take into account the situation. Is there water in front of the green? Is the wind blowing at you? Is it with you? Is what's the status of the green? Is it a hard green, a soft green? Okay, there's a lot of different variables that come into play. In other words, a 100-yard shot seems like it should be the same every time, but you're not a robot. You've got to adjust for the conditions of the golf course. And it's the same thing here when it comes to trading. If you can, you don't have to, but if you can learn to make sense of the context of the market, you can then know whether you're better off going for a larger move if the market's really in flow with that direction of the trade, or if you're better off locking in a quick profit and taking a very tight stop. Okay, it's being able to match your personality first, and then the market context second, which really can take that exit strategy idea of entering exiting only when the evidence tells you to. It can take it to that next level. So I want to give some examples on this. And so I've got 3 different profit-taking strategies that I want to talk about. One we call the scale and trail. 2 is what we call the contextual target strategy, and then the contextual hold strategy. And then I also threw in another one here that this is a little bit counterintuitive, but I think a lot of you are going to like this. It's a loss reduction strategy, and it's going to really deal with a very painful problem that a lot of us tend to face. So I think you'll like that as well. The first one is the scale and trail strategy, and this tends to favor people that are more on the certainty side of the scale, the people that like to lock in their profit, get rid of their risk as soon as possible. Okay, in this case, you're simply going to be trading multiple contracts. It doesn't matter if you're trading 2 or 4 or 10 or 20 or 50, but multiple contracts. You're going to take off half of your trade pretty quickly and move your stop up to break even. So it's kind of getting to that breathing point right away. Okay, then you trail the remaining half of your position, or you could even break that up if you're trading, larger contract size. Trail the remaining half of your position, but use the level 2 and use the level 3 aggression bars to do that trail. Okay, so we're kind of combining locking in profit quickly with allowing the evidence to kind of guide us. Okay, so in this case, again, this is an older slide, doesn't matter, the logic is the same. Let's say you got in here at the low of this level 3 buying aggression bar. This will be called our level 3 retracement trade. Let's say you got in here at 1978 and you're taking a 6-tick stop, okay, 1.5 stop. As soon as we get up a point or so, lock in, lock in, scale out of half your position. So if you're just trading 2 contracts, get out of 1 contract, move the remaining contract up here so that it's either a very small win or a break-even trade. You've locked in break-even. Now we don't know what's going to happen. It's either going to it could continue and become a home run. It could be a very small winner. But what you want to do is just trail your stop using any new buying aggression bar that comes in. So in this case, there's a level 2 buying aggression bar. Put your stop a couple ticks below that. Okay, it's not hit. Now we keep moving higher. Here's another level 2 buying aggression bar. Let's trail our stop a little bit higher. Okay, here we go. It's just a trailing stop strategy, but you're using the buying and selling aggression bars to help you manage that trade more effectively. So that's the scale and trail strategy very quickly. The contextual, I see a comment here that this is it's halting. Is that hopefully that's not a problem, but I guess I'll just continue on, even if it is. The next strategy here was what we call the contextual target for people that don't really like to trail their winning trades. They prefer to have a set target. Okay, and that's totally fine. I think there's a lot of validity to that approach. But you can increase your expectancy. You can increase the effectiveness, in other words, of the target-based strategy by adding market context. So, for example, if you've got a neutral market or you're kind of swimming upstream, you want to keep your target pretty tight. So whatever your stop is, your target's about the same. Okay, because the market conditions don't justify really going for a bigger move. Now, let's say that you're getting long and the market is pretty bullish. You're going to want to go for a 2-to-1 or a 3-to-1, reward to risk ratio, if you will, because market conditions say that that's your highest expectancy way of looking at the trade. Now, if it's extremely bullish and you're thinking about getting long, then you're going to want to go for at least a 3-to-1. So if you're risking 8 ticks, you want your target to be 24 or 32 or 40 ticks or whatever the case may be, because the opportunity exists. Now, are you always going to be right? No, you're not always going to be right, but that's not the right way to think. The right way to think is, what's your highest expectancy? What's the best probability? And if you are able to identify an opportunity where we're in a vertical mode up and there's a lot of buying aggression in the market, then you want to try to maximize your gain on that opportunity. So you're going to want to set your target a little bit greater than what you would have otherwise. Okay, it's using context to help you increase your expectancy on, on the type of target that you want to choose on your trade. So in this case, the same example. Assume you're long here at 1978. If the market conditions is neutral, you've got a 6-tick risk. Lock in a 6-tick profit. Boom, done. If the market condition is more bullish, go for a 2-to-1 or greater. Lock in it. You've got your 12-tick profit right there. Going for if the market is extremely bullish, you want to lock in an 18 or 24 or 32 tick profit. And so your target would be up there. Now you can still trail at the same time, but you're just trying to optimize where you place your targets based on the condition of the market at a given time. Okay. Again, this approach requires you to think. I know a lot of newer traders that don't really want to think. They want to just use certainty and just follow rules. That's not this approach. This approach is for people that really want to think. It's for people that want to unlock the puzzle of the market. We have found that works. We have found just being a ABC, paint by numbers, robotic type of a person doesn't work. That's been our experience. So I just want to make it clear kind of how we look at this thing. This is for thinking people. This is for people that want to really understand what they're doing and become a better decision maker with their trading. So again, not for everyone, but hopefully it's making sense to some of you. So this next strategy is what we call the contextual hold strategy. This is probably my favorite way of managing trades. I do a hybrid approach of these sometimes, but this is probably my favorite approach. And in this example that I'm going to talk about, let's just assume that you're long. This is a little bit more in depth, but I think you can follow along nicely. Again, you got long, and let's say you got in because there was some pretty good bullish evidence. Okay, so it again makes sense to stay in or to hold the trade until that bullish evidence is no longer there. Okay, so there's 2 ways to go about this. The first way, and I call this the burden of proof. You want to use market context to determine the burden of proof. So again, in this example, we're long. Let's say that you got long, but the market context was neutral or maybe slightly bearish, but you still, for whatever reason, decided to get long. You want the burden of proof to be on the market to prove that you should stay in. Okay, so in other words, you get in and you want to be what we call nimble. You want to make sure that the bulls start to come in pretty quickly, or that there's no bearish evidence that comes in at all. If there is, you just get out for a small loss, because again, you're swimming upstream, and that's the context of the market, and you need the burden of proof to be on the market to prove to you that you should stay in. Now compare that to you got long and the market context is bullish or extremely bullish, okay? In this case, the burden of proof is on the market to prove that you should get out. In other words, your default position should be, I'm holding this position as long as possible until the market actually proves with legitimate selling that I need to get out. Hopefully you see the difference there. Based on the context of the market, you're asking the market to either prove that you need to stay in or you're asking the market to prove that you should get out. Okay, burden of proof, if you will. And so in this case, let's just give an example. This is the same example I've been using for a while. Let's say that the market context is neutral or worse. Okay, so you're going against the grain, or you're swimming, paddling upstream. Okay, you're taking a long trade, even though the greater context is saying that might not be the greatest idea, but you do it anyway. So in this case, your first priority is protection, is risk management, protecting your capital. In other words, you want the market to prove that you should stay in. So if this thing goes against you at all, you get out. But if it starts going with you, great. Just keep trailing it up there. The first sign that either buying is not having follow through or that selling is coming in this case, we had a buying bar, we had a full bar below it, get out. Okay, it's our first sign that that there wasn't follow through with buying. We're looking for any possible evidence in the world to get out of this trade because the burden of proof is on the market to keep us in. Because again, the market context is neutral or worse on our long trade. Now you compare that to the market context being bullish or strongly bullish. Okay, in other words, this time the burden of proof is on the market to prove that you should get out. Okay, so in other words, you're paddling downstream, you're swimming downstream. So your first priority is profit maximization. Okay, you want to hold that trade as long as possible, exit when there's actual selling that comes in. Again, sometimes you're going to lose out on a small profit, but overall, when you can identify a situation like this, and this is what we teach, the odds are on your side and you want to maximize that potential gain as much as possible. So again, let's assume we're long here. We're going to hold this trade. I mean, if we get stopped out, we get stopped out, but we want to hold this trade as long as possible. So is there any selling here? Nope, no selling. Okay, we're still watching it. No, we go sideways for a while, but no sellings come in, so I'm still holding this trade. Oh, great, more buying, more buying, more buying. Okay, here's some selling finally. And now we got a bar below that. Now it's time to get out, okay? You don't get out until the selling actually proves that you should, okay? That's hopefully that makes sense. It's a little bit in depth, but once you learn this concept, the key is just to understand the concept. But once you learn it, you're again applying that idea of market context and market evidence to make your trade exit decision rather than depending on your gut emotion, rather than depending on fear or depending on greed. You're using evidence and you're using market context to increase your edge drastically. Okay, hopefully that makes sense as well. So next I want to talk about, I guess I call this a counterintuitive loss reduction strategy. So what we have seen time and time again, and I've certainly done this, is that a lot of traders use stops that are too tight. And some of you are saying, well, that's crazy. You've got to use tight stops to protect your capital. And you're right. The logic behind using tight stops is very sound. However, what can happen a lot of times is that you just get nicked or you get shaken out of a trade that would have gone in your direction. In other words, you were correct, but because you had such a tight stop, just by the natural ebb and flow of the market, you got taken out before you were able to take advantage of that trade that you were actually right about because your stop was just too tight. You're trying to manage risk too tightly, so you lost out on opportunity. So the solution to this is what we call kind of the emergency stop plan plus a monitor the evidence. That's not a very good title, but that's basically what it is. You want to make sure you're protected and then monitor the evidence. And let me give you an example with that. So in this case, again, let's assume that we're going to take a long trade. We're going to set a wider than comfortable stop. So if your normal stop on the E-mini S&P, for example, is 6 ticks or 8 ticks, you might want to set a 12 tick or 14 tick stop. That's a stop that you don't want to get hit. That would be uncomfortable. That's a bigger loss than you would like to take. But again, we don't anticipate this will get hit. This is our emergency stop. Say 5% of the time. It's more like 3 or 4. And that's only going to happen when the market, a news event comes out or the market just has a wild reaction. You want to protect yourself against, an outlying event. Okay. So you got that emergency stop in place. The next thing you want to do is monitor evidence to see if the other side is coming in. So if you're long, you're going to have that wider stop, and you're going to stay in that trade unless there's a level 2 or a level 3 selling bar that enters the market. In that case, you can get out of the trade, and almost all of the time, that loss is going to be equal to what your normal stop would have been, but it's going to allow you to stay through that wiggle if there's no true selling that's come in. Okay, so an example of this. On the left here, let's say that you got long here and you'd like to have a stop that's in here, money, based on money, okay? But you put it in an emergency stop. So that if things just go horribly wrong, you're going to get stopped out and you're not going to lose your account. You're going to take a painful loss. It's not going to be fun. It's a little bit, larger loss than you'd like, but it's rarely going to happen, okay? What this does is if you see this market retraces a little bit, but there's no selling that's come into the market, you hold through where you would have normally been stopped out, then the market. On the right is an example where you get long, your emergency stop is down here, but you could see we actually had some true selling, this level 2 selling aggression bar that came in. It's showing us, okay, there is some legitimate selling. We have a close below it or a full bar below it, however you want to define that. Okay, we can get out of this trade. There's actual selling coming in. So your actual, where you ended up getting out of the trade is where your normal stop would have been anyway. It just allows you that room to let the trade do what it's supposed to do unless you're proven that you need to get out. So again, that's not for everyone, but so often, it's amazing how many times you hear from people, oh, I missed a 10-point move because I got stopped out to the tick. Well, you were using a 4-tick stop. That's just natural give and take. And so, if you can use structure and context and then let the market tell you when you should get out while still protecting yourself, you can kind of have the best of both worlds in a large sense. So again, hopefully that makes sense. Now, we've talked a lot about these aggression bars. I want to point out this is just kind of the tip of the iceberg. We have, the aggression bars are shown in real time. We also have an indicator called the high velocity moves. We have real-time support resistance zones. We have deceleration divergence bars. We have a filter, kind of a path of least resistance filter. We also talk a lot about bigger picture bias and bigger picture key levels as well. So we can kind of put all of those, pieces of evidence in our mixing bowl, mix it up, and make better decisions. Or you could look at, I guess I have a puzzle picture here. It's the same thing if you were doing a puzzle on your table. The more pieces of the puzzle that come together, the more clearly you're going to see what that puzzle is representative of, and the better you're going to be able to make decisions. And the better you make decisions, the better your results are going to be. So it's that idea. The more pieces of evidence that come together to support a decision, the greater your edge. So we've talked a lot about relative aggression bars. I guess we've talked only about relative aggression bars. You can go on our site and learn more about these other tools, but there's a lot more than just relative aggression bars. Although, I mean, if you put a gun to my head and said I've got to pick one, I would just trade with relative aggression bars. But obviously, if I can use all of these, it helps me even more. So, and we've talked a little bit about trade entry, a little bit more about trade exit. But again, especially if you're a new trader, I think this is a very important point. That's just part of being a successful trader. Trading is kind of a holistic endeavor. It requires a focus and a continual improvement on every aspect of trading. So it starts, again, I mentioned that exercise that talks about your self-understanding. That goes to then that leads to market understanding. That leads to, if you have good market tools, you can see the market better. If you have good trading skills and techniques, good entry, good exit strategies, that's where that comes in. You're dealing with the mental side of things, and you're not trying to. So many of us think we need to be robots and suppress our emotions. That's not the way we look at it. We look at it as we're humans. There's no way to possibly suppress our emotions. So we want to be aware of our emotions so we can flow through them, and that's how you deal with the mental side of the game. Then you want to review and improve, and you've probably heard the idea of the downward spiral. Okay, this is an idea of an upward spiral. So we're constantly looking to make incremental improvements in each of these facets of our game, if you will, that over time, I mean, you can have immediate gains, but over time, it really makes you an outstanding trader. So again, that's what we focus on. So many people are just focused on trade entry, and that's all they think about. You're screwed if that's the way you're looking at trading. You've got to look at this as the whole person, okay? If you're serious about doing this for a career, okay? In terms of what's included when you become a member with us, you've got full use of the software, again, the relative aggression bars, which we talked about a lot. high velocity, support resistance, the deceleration and divergence. And that's basically telling you when, that's if the aggression bars are the acceleration pedal, the deceleration and divergence bars are the brake pedal. Okay, it's telling when the market is likely at a turning point in the short term. So we've also got the filter. You got full access to our daily market assistant. That's a daily report that we do. Kind of sets your homework or sets the stage, your strategy for the day. Full access to we do a lot of live market education sessions. We have a very thorough training section and really full service support, whether you need help getting everything set up technically. But beyond that, we really want to help you with any questions questions, a trade decision question, whatever it may be. We really want to be there to help you, and we are. We get back to people very, very quickly. And this is an intangible, but we really do care that you succeed. I know how much a mentor has helped me in my career, and Dave and I try to pay that forward, if you will. We really do want you to succeed. We're not into selling. We're not into we're really looking at ourselves as traders first, educators second, and then we run this business third. Whenever we get a new member, we really want to dive in with them and help them succeed. So that's that. What we're going to do, I'm going to we have some time here set aside for some questions, and I'll get to those in a minute. But what I want to do is, again, I'm not going to be pushy and try to push you to sell something, but I do want to mention that if you are interested and if this resonates with you, you like this idea, go ahead at info@daytradethemarkets.com. We'd like to be able to get to know you a little bit, maybe tell us a little bit about yourself, your trading style, whatever the case may be. But I'll also I don't want to, kind of announce this publicly, but I do have a really special offer. It's a really amazing offer, actually. I don't want to announce it publicly. If you're interested in that, just send us an email. We can start a conversation. I can tell you about that deal. I can also answer any specific questions that you might have. I'd have to create I'll send you a special discount link that I've created. It's not available on the site, so you'd have to email us to do that. So again, if you're even remotely interested in what we've been talking about, I highly recommend you at least send an email, because it is a pretty good deal. It's a better deal than that, actually, but that's the presentation, I guess, at this point. I wanted to leave some time for some questions. I see that there are Kayla, how do you define selling? Yeah, define selling by when selling aggression comes in. If you were there for that part of the presentation, we talked about how the relative aggression bars are showing you what's going on under the surface of the market. So that's how that works. F is asking, who is your mentor? My mentor is a guy named Dave Johnston, and we actually work together now. I tried to go it alone, and I'd buy every package and go to conferences and spend all night looking up new strategies and back testing and doing all this and that for years. Very poorly, failed at it. When I finally met Dave, just by chance, he actually, he is the one that helped me learn about what really moves the market, how learning to understand the context of the market first is so much more important than trade entry, because the trade entry just flows with the context of the market and that sort of thing. Hopefully that makes sense. There's more about that on our site as well. Doriel is asking, do you have these indicators for MetaTrader? We don't have it on MetaTrader at this point. What we tend to recommend, and you can email us with what you're using, and I can give you a good option. We tend to like NinjaTrader, and what we like about that in a lot of cases is that even if you're trading on something else, you can use Ninja for free, and we can help you get a free data feed as well. And so then you could still keep everything the same that you're already doing and trade on whatever platform you are. You would simply add, another chart or charts or however many charts you'd want that would be ours, which you'd have to do anyway. It would just happen to be on NinjaTrader, but you could do it for free. It won't cost you anything. We can help you get it set up. That's kind of the first choice we typically like, but there are other options if you want to get back to us on that. Saw a question earlier that said, do you believe in setting a trading goal? I actually have an opinion on this. I strongly advise against setting a daily trading goal, because when you set a daily trading goal, you're basically, it sets you up to fail in two different ways. Number one, let's just say you have a daily goal of $500, okay? Well, and it goes back to our, kind of how we were raised in our society, in that you go to work for the day and you get paid for the day. And, when you're trading, you should make money. That's just how jobs work. Trading doesn't work that way. It's not a job. Trading is about making good decisions and getting paid for making good decisions. Sometimes there's not $500 to be made, okay? But what happens if you set a $500 daily goal and this just doesn't exist? Well, almost all the time you're going to force trades. You say, well, I've got to make money. You're going to force trades. What's that going to lead to? It's going to lead to bad decisions. That's going to lead to bad results. And those tend to compound on top of themselves. I know from experience, that's what happened to me. That was always my weak spot. When I would take a couple losers, I would become a crazy man and I would, start chasing, and I'd have these huge down days. Well, if you're going for a daily goal and it's just not there that day and you're going to force it, you're going to end up losing a bunch. So you have unlimited losses, if you will. And on the flip side, if you've got a daily goal and you quit after you make your $500, what if that was a day you could have made $2,500 or $5,000 or whatever the case may be? Okay. You have to, in our opinion, follow the market context. It doesn't mean you have to trade all day, every day. You want to trade when you're fresh, when you have the ability, when you're in a good state of mind, but let the market dictate what you make that day. Don't set an arbitrary goal. I guess I strongly disagree with that advice. I saw that question earlier. Frank is asking, can the software be adapted to work with Bloodhound? Yes, that is, it's almost done. We're working with the programmer to do that. I would recommend, if that's something of interest, to jump at this deal, and then when it's available on Bloodhound, it'll just be all the better. We won't add any cost to that. Let's see. See if I missed anything. Please go ahead and send another question if you have them. Rosa is asking, do you offer mentoring classes or just software and education? Yeah, great question. Oh, it's much more than just software and education. Like we were, let me just run this slide back. This is how we look at, if it was just software and education, you'd just be in this market tools category, okay? And we look at trading as so much more than that. We look at it as really understanding yourself, and we can help you with that. Really understanding the market, which is huge. Then you want to have these good market tools. That's what we've talked about. And you want to have good trading skills and techniques. That's entry and exit and account management and all of those things. We talk a lot about that. You want to talk a lot with the mental side of things. We deal with how you can assess yourself and improve. It all comes together. It's not just software. If you're just looking for software, that's not enough. I mean, if you're a very experienced trader, we've had a lot of experienced traders just take the software and we never hear from them again, and they're happy. But for newer traders, by all means, we have a very thorough training section. We do live education sessions. We're always available on email or phone, whatever the case. So it's much more than an indicators. And again, at the price of this special, it's you'll be amazed. Kunal is asking, is this just limited to E-minis? No, this will work on any exchange traded market. I tend to personally trade the E-mini S&P, crude, and gold as kind of the three that I tend to focus on. We have people that trade anything. I mean, Russell, NASDAQ, YM, of course, Euro, currencies, bonds, stocks with that data. You could, any exchange traded market, this can help you. F is asking what data feeds. It depends on what platform you're using, but there's a multitude, and we can explain that. We can explain that with no trouble. We have a few more minutes here. Rosa says, can you make a living just on your trading, and do you have third-party verification? Well, we've got, I don't know if I have third-party verification, but we've got literally hundreds of hours of live trading education sessions, and you'd be able to tell by watching that if we know what we're talking about or not. Can you make a living? Yeah, absolutely. You can make a living in trading. I look at myself, I guess, as kind of about a half-time trader, half-time running this business. and there is kind of a trade-off that goes along with that. I look at, I think what I have found and what I advise is if you're trying to make your mortgage with your trading each month, it's a lot more difficult than if you've got your bills paid for, okay? Just because it adds that pressure, and we talked about what pressure does to you in that sense. So if you can get to a place where you've got your cash flow taken care of, you're going to be a much more effective trader, okay? So that's why, I don't trade all the time because I run this business, but it's a trade-off that I like to make because this takes care of my, monthly cash flow, and my trading just goes to, building that up. Yeah, F and Rosa, send us an email on that. Let's see. See if there's any other questions here. And we have a lot of, we have all kinds of different people in our membership. We have guys that are trading huge, Rosa says, but some outlets cheat on the statement. That's why third-party verification is better. Okay, we can show you some stuff like that, but of course anyone could, I guess, cheat on that. I think that's not really the point, though. I think the point is, and this is what's clear, is you're not going to trade the same way as me. I'm not going to trade the same way as you. I don't trade the same way as Dave. I don't trade the same way as a lot of our members. There's no one right way to trade. By saying that, you're saying basically you're looking for a system. Okay, in our strong opinion, their systems don't work. It's about fundamentals, and it's about being able to understand what the market's doing, why it's doing it, and then being able to see that. That leads to being able to make better decisions than you would have otherwise. That's really all that it's about. There's no holy grail. There's no, it's really irrelevant. It's about helping you make better decisions about your trading. So hopefully that makes sense. Yeah, we'll do, Raymond. Daryl says it's probably the 80-20 rule. 20% are making money and 80% are losing money. Yeah, I think that's about right, actually, in generally speaking, in the trading population. And I would even say it's probably more like 2 or 3% are making huge money. Okay, but that's the same. You have to look at trading. This is not a job. This is a performance endeavor. Okay, this is like being a professional athlete or a professional actor or musician or anything where you get paid based on your performance, or a salesperson. Okay. In any endeavor like that, Meryl Streep makes more than a character actor on, Law and Order, and and then there are a lot of actors who are waiting tables. It's the same idea. The vast majority of 80% of people are not making a living. 20% are, and the top 2 or 3% are making a huge income. Okay, and so really, I think that's how it works in any performance endeavor. I wouldn't be afraid of that. I would work to get toward that top 20% and then that top 3% or top 5%, whatever it may be. Okay, so that's how I look at it. In terms of how this tool can help, it's not going to turn you from a losing trader to a top 3% trader. It's going to turn you from a losing trader to a better trader than you were before you had it. So no huge promises. It's simply going to help you see the market more clearly than you would have before, because it's based on really sound logic. And our education, I feel, is we have a lot of people that would agree with that, is very top notch. So again, I don't want to get into selling it. It's not the point here. I wanted to just explain what it was all about. So hopefully that makes good sense. Looks like we're about out of time. If there are other questions, though, we have about 2 minutes to go if there are other questions. Daryl is asking, do you need at least 20K to work with to give yourself a good chance? I think you can make decent money with less than that. But I think that's a good number. Yeah. I think that obviously the more you have, the better chance you have to make good money, because you're always going to trade a small percentage or risk a small percentage of your account on any given trade. So if that small percentage of your account is larger, you can make more money. You can still make good money starting with 5K, but the more you have, the better, obviously. But it doesn't mean you can't do it. F is asking, can you tell us about your background and experience? Sure. I started trading in early 2000s. Started by doing some of the long-term trend stuff. basically wasted a pretty good inheritance by my grandfather, but learned a lot, I guess. By the end of that, I said, well, day trading is more of my thing. I learned that, but I was basically out of money. So I spent the next, several years doing, website design and silly stuff like that, just trying to build up small accounts that I would then go and blow out because I didn't know what I was doing. Again, it wasn't until I wasn't able to turn the corner until I started to stop looking at trading in terms of finding systems and in terms of finding these amazing entries, and started to understand that it's about, it's about really seeing what the market's doing and understanding the context of that. So Mike is saying, Justin, maybe a good suggestion is for those that are not sure is to provide the link to your site that has several videos. I'm a longtime owner of DTM and would never trade without it. Oh, thank you. It shows me the market context and I use another entry and exit for my trades. Yeah, perfect. Yeah, so there is, if you go to our website and you click on the Learn More tab, there's like 5, there's like 5 kind of overview videos. And I typed the link in there, and then there's a blog where there's hundreds of videos on there. You can kind of see a lot of different examples. And don't forget to send us an email if you are at all interested in that special offer. You can see the normal pricing on the website as well. So yeah, Mike, I really appreciate that comment. And that goes back to what we were saying earlier about, there's a lot of different ways to use this tool. Some people use it as a decision aid, like Mike is here. He's saying that he has his own entry and exit strategies, but he uses our software to provide better market context. In other words, to see our bulls in control, our bears in control, are we in a vertical, are we in a horizontal mode, and there's so many different ways to use it. Again, you don't want to get fixated on, and this is such a new trader phenomenon, not being critical, just what it is. You get fixated on, systematic approaches, and that's not, at least in our opinion, that's not the way to successful trading. The way to successful trading is understanding the context of the market and then understanding how to, judge an opportunity and manage risk that's according to that. So we're about out of time here, I'm seeing. What I would love is if you send us an email with any other questions that you have and inquire about the special. And again, running out of time here, but big thanks to Trading Pub and for everyone that attended. We very much appreciate that.